participants.
जी ठीक है.
Now we are live.
Bismillahirrahmanirrahim. Welcome to webinar on IFRS 18. So welcome to webinar on IFRS 18. The webinar has been held in order to give, a brief about the requirements of IFRS 18 and how it impacts the financial reporting by the companies. And SCCP has adopted IFRS 18, and it is effective for accounting periods beginning on or after January 1, 2027. So we begin the session with the recitation of Holy Quran with the name of Allah, the most gracious, the most merciful. Bismillah, A'udhu billahi minash shaitanir rajim. Bismillahir Rahmanir Rahim. Qul huwallahu ahad, Allahus samad, lam yalid wa lam yulad wa lam yakul lahu kufuwan ahad. Sadaqallahul Azim. Now, I would like to invite our esteemed Chairman, Accounting Standard Board, Mr. Mohammad Abdul, to give his opening remarks for this session. Over to Maqbool sir.
Bismillah ar-Rahman ar-Rahim. Thank you, Imran sir. Assalamu alaikum and very good morning to you all. It gives me great pleasure to welcome you to this vital session hosted by Accounting Standard Board of Institute of Chartered Accountants in Pakistan on the understanding of the requirement of IFRS 18, which is the presentation and disclosure in financial statements. The application of this standard has been notified by the SCCP effective accounting period beginning on or after January 1st, 2027, which is exactly the date which is prescribed by the International Accounting Standard Board. The Institute of Chartered Accountants in Pakistan is a member of the IFAC, and therefore it has a commitment to comply with the Statement of Member Obligation called SMOs. SMO compliance encompasses various dimensions, including standard setting, education, quality assurance, and investigation and discipline framework. And SMO 7 talk about the standard setting, and where we are responsible as a PAO of the IFAC to ensure the adoption and implementation of IFRS in our jurisdiction as issued by International Accounting Standard Board, thereby contributing to the global organization of financial reporting. In achieving this global harmonization, the role of Accounting Standard Board is very important. The Accounting Standard Board, which I have the privilege of chairing, is composed of diverse and well-represented body of professionals and experts from various sectors, including audit and accounting practitioners, academia, industry, and regulators. This broad representation ensures that our deliberation and recommendations are grounded in practical realities and aligned with global standards. The primary mandate of Accounting Standard Board is to review, evaluate, and recommend the adoption of IFRS to the Council of the Institute of Chartered Accountants in Pakistan, which then forwarded its recommendation to the SCCP for the adoption of that standard in Pakistan. We have completed this process, and now the standard has been notified by the SCCP for compliance and application effective 1st January 2027. The Accounting Standard Board also support and provide guidance on the implementation of IFRS accounting and IFRS sustainability disclosure standard in Pakistan. Purpose is to ensure the consistency with global best practices while tailoring them to the needs of our local environment. Today's session focuses on very significant new standard which is IFRS 18, issued by International Accounting Standard Board and adopted by SACP. This standard introduces a new structure to the financial income statement, and is in response to the long-standing concern raised by the users of financial statement regarding comparability and clarity required for performance reporting. This standard aims to enhance transparency, consistency, and usefulness of financial information presented by companies within their financial statement, especially around the presentation of statement of profit and loss account. The standard introduces certain presentation requirements like mandatory subtotals and categorization of all items of profit and loss account into three categories: operating, investing, and financing. And also, this standard put in place a requirement of specific disclosures on management-defined performance measures in a single note to the financial statement. Now, as we navigate through the presentation discussion today, I encourage each one of you from the audience to ask questions which will be answered after the presentation of IFRS 18 to be made by Mr. Imran by our distinguished panelists. And let me take this opportunity and state that the successful implementation of IFRS 18 not only will elevate the quality of financial reporting in Pakistan, but will also meet the regulatory requirement. Once again, I thank you all for your presence, and I expect an active participation today. Thank you. Now I request Mr. Imran to make a detailed presentation on the requirement of IFRS 18. Thank you, Mr. Imran. Go ahead, please.
Thank you, Maghboob. So, IFRS 18, as the name tells, presentation and disclosure in the financial statements. So, the IFRS 18 is basically a standard dealing with the presentation and disclosure in the financial statements. As Maghboob explained, that it is applicable for accounting periods, reporting periods beginning on or after January 1, 2027. And this is ISP notified date, and it has also been, notified by ICAP with the same effective date. So in Pakistan, the reporting beginning from January 1, 2027 will be in accordance with IFRS 18. As of now, we have IS1 in application, and IS1 also deals with the presentation disclosure in the financial statements. IFRS 18 has been brought in to replace IS1 while retaining many of the core principles. So our presentation will be around the changes that have been brought in by the IFRS 18 vis-a-vis IS1. So the core principles of IS1, for example, frequency of reporting, materiality, identification of financial statements, comparative figures, those all remain the same, which were there in IS1 and have been carried forward as same in IFRS 18. IFRS 18 does not change any recognition and measurement criteria for any of the financial statements. As I said, it is about presentation of financial statements. It does not deal with the recognition and measurement of any of the items of financial statements. The IFRS 18 mainly brings changes to the statement of profit or loss. It does not change the presentation in the statement of other comprehensive income or a statement of changes in equity. It brings in a few changes, rather one change as regards, presentation of the statement of financial position. I'll be coming to that as well. And as regards the statement of profit loss, it brings in, 5 categories within which the items in the statement of profit and loss can be categorized. So I'll be discussing them as well in coming slides. And those 5 categories include basically 3 main categories: investing, operating, and financing, categories. As of now, we have these categories in cash flow statement. So similarly, I mean, we will be having these categories, or let's say classification of our items of, income or expenses into these categories into the statement of profit or loss. And there is a requirement to present certain totals and subtotals, mandatory totals and subtotals in the statement of profit and loss. I'll be coming to that as well. IFRS 18 has also introduced a concept of liabilities that from transactions that involve raising of finance. So it talks about, it gives you guidance about income and expenses arising from those liabilities as to where the income expenses are arising from these liabilities that involve raising of finance need to be categorized, whether financing or investing or let's say operating. So it gives you guidance on that. It also gives you guidance on how, where the foreign exchange differences need to be categorized into the statement of profit and loss, whether investing, financing, or let's say operating. So it gives you guidance on that as well. And it adds an added disclosure requirement for management defined performance measures. And it gives you definition criteria as to what a management defined performance measure can be, and when it needs to be reported, and what is to be reported in that single note, is also provided in the requirements for IFRS 18. It gives you requirements of disclosure. It gives you flexibility. Either you can use nature of expenses or function of expenses to categorize items in the statement of profit and loss. It says that when you classify based on function, then you need to give nature of those expenses, in the notes of the financial statements to explain them. It also, besides that, it also requires, to give in a single note explanations or bifurcation of certain expenses, 5 expenses, into a single note, explaining their nature and as to how those expenses have been bifurcated into various, categories into the statement of profit and loss. So I'll be coming to that as well. As regards cash flow statement, there have been certain changes brought in consequently to the IFRS 18. There are 2 changes. I'll be coming to that as well in coming slides. As regards balance sheet, one change, which I said, one single change has been made as regards statement of balance sheet, statement of financial position. So that the change is that now IFRS 18 gives distinctly, line item of goodwill to be shown on the face of the balance sheet or statement of financial position. Earlier, IAS 1 did not have this, and it gives you a flexibility to give additional measures of earnings per share. Today we have, if I talk about IAS 33, we can give we are required to give two numbers, basic earnings per share and diluted earnings per share. But IFRS 18 gives you flexibility to give as many disclosure additional earnings per share as you like, based on certain requirements. I'll be coming to that as well. So what about profit and loss reporting? So basically, items in the profit loss statement of profit loss are now, post implementation of IFRS 18 as part of requirements of IFRS 18 are now required to be categorized into operating, investing, financing categories and into income taxes and discontinued operations. So if we look at the statement of profit loss, you will have to now post application of IFRS 18 categorize the items of income expenses into these 5 categories: operating, investing, financing, income taxes, and discontinued operations. But how to categorize? It gives you guidance on that as well. So for a normal manufacturing concern or a service organization which does not have, investing or financing as its main business activities, the principles are clear, as contained in IFRS 18. It states, it gives you, it requires that income generated from assets and income generated from following assets. I mean, three categories: investment in associate, joint ventures, and unconsolidated subsidiaries, cash and cash equivalents, and other assets which are able to generate and return individually and largely independent of other resources. I mean, these three categories of assets, the income and expenses arising from these three categories need to be categorized into investing category in the statement of profit and loss as per requirements of IFRS 18. So what says that income generated by these assets, income and expenses arising from subsequent management and derecognition of these assets, and income expenses directly attributable to acquisition and disposal of these assets. So basically, these three categories need to be looked at, need to be considered, kept in mind while categorizing the income expenses into investing category. What about financing category? So it gives you, it requires that basically two things. It requires that all income expenses that relate to liabilities that involve raising of finance, for example, bank borrowings, or for example, bonds issued by the company. So income expenses arising from financing liabilities, from liabilities that involve raising of finance, need to be categorized into the financing category. And besides that, interest expense and effects of changes in interest rates, from other liabilities, be it, let's say, pension liability, be it, say, let's say lease liabilities. So interest expense and effective changes in interest rates need to be categorized into financing category. So these two principles are are clearly given in IFRS 18 regarding investing and financing. And as regards operating, what it says that any items which are not categorized into investing category or financing category will be carried forward, will be categorized into operating category as per requirements for IFRS 18. So what about entities which have their main business activity as investing into assets, let's say, or providing financing to customers? For example, banks, they have their activities of investing in particular type of assets, or providing loan to the customers, and providing financing to the customers. So the principles change for them. So we will look at the principles for them as well in the coming slides. But it gives you, IFRS 18 gives you guidance as to how to identify whether your main business activity is investing into assets or providing financing to customers. So IFRS 18 basically requires you to use judgment and look at the following sources for identifying whether your main business activity is investing into customers or providing financing to customers. So what you need to look at is whether the entity is giving its performance, is explaining its performance, internally, the measures, the KPIs which the entity is using to explain its performance externally or internally. For example, banks usually give their net interest income or income. Let's say an entity involved in investment properties, gives the measure, let's say, of income from investment properties and net financial results. So you'll have to look at your performance reporting, and your performance reporting will help you to identify what your main business activity is. Similarly, it gives you, it requires to look at the information contained in operating segment note, and that information would also help you identify your main business activity. So these are the sources of guidance which IFRS 18 requires you to consider while identifying your main business activity. And if you are into investing, or if you are into providing financing to customers, then the principles change. You'll have to look at the principles contained in IFRS 18, while categorizing your items of income expenses into operating, investing, and financing category. And one key point is, there may be a case when a subsidiary has a different activity, main business activity, and the parent has different. So every entity will have to look at its own operations, own performance reporting to identify what its main business activities, and accordingly it'll have to categorize its items of income expenses into its statement of profit and loss as per requirements of IFRS. This table, gives you a detailed guidance as to how items of income and expenses need to be categorized into statement of profit loss It clarifies both for entities which are normal entities, normal manufacturing concern, or let's say service organization. It also gives you information on the requirements to categorize in items of income and expenses for an entity which is involved in providing financing to customers, or which is involved into investing in assets, certain assets. So there, the table shows non-operating assets. Under the non-operating assets, there are three categories, which IFRS 18 specifically, talks about: investment in associates, joint ventures, and unconsolidated subsidiaries. Other non-operating assets, for example, financial assets, inventory, cash and cash. So these categories, three categories, if you are a normal organization, if you're a normal manufacturing concern or a service organization, so income and expenses arising from these three categories will be categorized into your investing side. But if you are into main business activity, if your main business activity is investing into these assets, then the principles change. For example, I mean, if and one key thing is that investment accounted for under equity method, always income expenses arising from investments accounted for under equity method will always be categorized into investing category. Whether you are a manufacturing concern or a bank, income expenses arising from investments accounted for under equity method will always be categorized into investing category. What about other investments? Other than those which are accounted for under equity method, you'll have to look at whether investing into these investments is your main business activity or not. If it is your main business activity, then you will have to categorize income expenses arising from these assets into your operating category. If not, then for example, if you're a manufacturing concern, if not, in your case, it will be categorized into investing category. Other non-operating assets which are able to generate returns independently, as I said earlier, for them, if you are a normal manufacturing concern and it is not your main business activity, then the income expenses arising from these assets will be categorized into your investing category. If you are into this business, for example, if you are a bank, so in that case, the income expenses arising from financial assets, investment property, or other assets, I mean, which are able to generate independent returns and in which you are into, then if it is your main business activity, then its income expenses shall be categorized into operating category. Cash and cash equivalents, you will have to look at if it is investing into cash equivalent is your main business activity. If not, then the principle is clear that you will have to categorize income expenses from cash and cash equivalents into investing category. For a manufacturing concern, cash and cash equivalent income expenses arising from cash and cash equivalent will be categorized into investing category. But if you are into business of investing into cash and cash equivalents, then the principles change, and then it will become your main business activity, and the income expenses are from cash and cash equivalent will be categorized into operating category. And if you are also, am I audible?
D, we can hear you.
Yes, you are.
Yeah. So if you are into if investing into cash and cash equivalents is your main business activity, then you will have to look at, then it will be categorizing expenses arising from them shall be categorized into operating category. But simultaneously, if you are also into a business of providing financing to customers, and there is a linkage between the two, you invest into cash and cash equivalents, and you also simultaneously provide financing to customers. So income expenses arising from cash and cash equivalents shall be categorized into operating category. But if there is no direct linkage, and then the standard gives you an accounting policy choice, that you can either categorize income expenses arising from cash and cash equivalents either into operating category or into investing category. For operating assets, for example, PPE, trade receivables, the criteria is simple. For the income expenses are from them shall be categorized into operating category. What about liabilities? So this table, shows you the requirements as to how income expenses from liabilities can be categorized into financing or operating category. So if your liabilities relate to bank borrowings, I mean liabilities that involve raising of finance, and if you are a normal manufacturing concern or a service organization, then in that case, the income expenses arising from those financing liabilities shall be categorized into operating category. But if you are into business of providing financing to customers, for example, if you are a bank, then the principles change. Then you will have to look at whether the liabilities that also relate to providing financing to customers, which will be a case for a bank. Then the income expenses arising from financing liabilities will be categorized into operating category. But if there is no direct linkage between the two, then in that case, IFRS 18 gives you an accounting policy choice. You can either categorize income expenses arising from financing liabilities into financing category or into operating category. Other liabilities, the principles are clear. For other liabilities, for example, trade payables, pension, lease liabilities, you'll have to look, you'll have to see what the interest elements are involved, whether the interest elements are involved. For example, a pension, if for a pension scheme, we have an expense which contains both, current service cost as well as, interest cost. So the interest cost element will be categorized into financing category, and the current service cost will be categorized into operating category. Similarly, other income and expenses other than those relating to interest expenses or changes in interest rates will be categorized into operating category. For insurers, the standard gives you explicit guidance that income expenses arising from instruments with participation features and insurance finance income and insurance finance expenses will be categorized into operating category. So for a normal organization, the principles are clear. For a normal manufacturing concerns or a service organization, the principles are clear that the income expenses from financing liabilities will always be categorized into financing category. For other liabilities, you'll have to look at whether the other liabilities expenses, expenses relating to them involve interest income or expenses, or interest expenses arising from changes in interest rates. Then those elements will be categorized into financing category. Otherwise, the other items of expenses relating to other liabilities will be categorized into operating category. So what are the other changes? Foreign exchange differences. So as of now, we normally categorize foreign exchange differences for a normal organization, for a normal manufacturing concern. We generally give it into other operating expenses. But IFRS 18 requires you to categorize, to bifurcate it into different categories of statement of profit loss based on category of items to which they relate. For example, I mean, if you have COGS in your profit or loss, and certain exchange differences were also incurred, for importing in the inventory that is now into the COGS item, then the related foreign exchange differences will be also be categorized into operating category. And so you'll have to look at the bifurcation of overall foreign exchange differences, and you'll have to actually bifurcate them into different categories of statement of profit loss, investing, operating, or financing. But at the same time, standard gives you a room that if bifurcating them involves undue cost or effort, then you can categorize the whole foreign exchange differences into operating category. I mean the differences which are not classifiable, which are not bifurcatable, which involves undue cost or effort, then you have the room to classify them, to categorize them into operating category. So what are the required subtotals? Basically, it requires three subtotals, for every prepared. First subtotal is operating profit or loss. You'll have to now, post implementation IFRS 18, you'll have to give a subtotal of operating profit or loss in your statement of profit loss. Then you'll have to give a subtotal of profit or loss before financing and taxes, income taxes, and you'll have to give a final total of profit or loss for the year. However, for a bank, for example, the entities, the IFRS 18 gives you certain presentation choices to categorize, to label appropriately the subtotal for the second subtotal, that is profit or loss with financing and income taxes, because in case of a bank, finances would generally be categorized into their operating category. So what are the what is management defined performance measure? and why ISB felt the need to give disclosure requirements on this area. Actually, entities or were usually reporting different performance measures into their external performance reporting, and the investors had concerns as to how those numbers have been developed. So there were concerns, from the investors around the globe as that there should be some, reconciliation or some information in the financial statements to explain as to how those performance numbers have been developed. And entities were, reporting different performance, measures in their external reporting. For example, within their annual reports, other than in the financial statement. For example, adjusted operating profit or adjusted profit or loss or adjusted EBITDA, free cash flow, etc. So the ISB felt the need that there should be a disclosure requirement. There should be a disclosure requirement, and there should be disclosure in the financial statements explaining, what the performance measure, how the performance measure has been developed, why the performance measure has been chosen, and etc. And how that number, actually reconciles to the number reported in the financial statements. So they have laid down certain principles in IFRS 18, and they have laid down the criteria as to what measures will qualify as management defined performance measures. So you'll have to look at the criteria provided in IFRS 18 to identify what management defined procedure performance measures are or exist in case of your organization. And if they do exist, if they do in case of your organization, then you'll have to give a note in the financial statements and meeting the disclosure requirements for IFRS. So I'll be coming to that as well. So what is the criteria? What is a management defined performance measure? So IFRS 18 defines management defined performance measure as a subtotal of income and expenses. So what the criteria, the principal criteria, the first criteria is that it need to be a subtotal of income and expenses. It cannot be a total of income only. It cannot be a total of or subtotal of expenses. It need to be a subtotal of income and expenses. First thing. The other criteria is that it should not be a performance measure which is listed in IFRS 18 or which is a subtotal required by IFRS accounting standards. For example, the three subtotals have been required by IFRS 18, which I earlier discussed. Operating profit or loss, or profit or loss before financing and income taxes, and profit or loss for the year. So these three, will not qualify as management defined performance measure. So if a performance measure is already there in the requirements for IFRS accounting standards, it cannot qualify as management defined performance measure. The third criteria is that the performance measure should have been used by the company, by the entity in its external public communications outside financial statements. For example, within the management committee, for example, let's say within the directors board, and this is the third criteria. The fourth criteria is that the entity perceives that performance measure to depict an aspect of the entity's performance. So these are the four criteria, 4 points that need to be met before an entity can identify, before can entity reach to the conclusion that this performance measure is actually their management defined performance measure. So these 4 criteria, 4 points criteria need to be met where in order to identify your management defined performance measure. And if the criteria is met, then you'll have to give disclosure as per requirements of IFRS. So what are the disclosure requirements? So I'll be coming to that as well. So IFRS 18 actually gives a list of subtotals, which explicit list, which you cannot categorize, which you cannot say that it is a management defined performance measure in your case. So this is a list which cannot ever be considered as management defined performance measure. Gross profit or loss or similar subtotals, operating profit or loss before depreciation, amortization. So this is a list. So that this list, IFRS 18 says that these cannot be considered as management defined performance measure. Similarly, IFRS 18 says that gross profit or similar subtotals, cannot be considered, cannot qualify as management defined performance measures. For example, net interest income, net rental income, or insurance service income, net fee and commission. So these cannot be considered as management defined performance measures as per requirements of IFRS 15. So what can be management defined performance measures? What can be those measures? So this list shows you the measures, the performance measures which can qualify as IFRS, as MPM under requirements of IFRS 18, subject to fulfillment of other criteria, other conditions. EBITDA, this can be a management defined performance measure. Adjusted EBITDA, operating profit before restructuring cost, or let's say operating profit before research and development expenses. So these are the examples. So these can be your management defined performance measures. And when we carried out a study as to what is the common performance measure which qualify as MPM in case of Pakistan. So we identified that EBITDA is most commonly used performance measure that potentially meets the criteria of MPM under IFRS, under requirements of IFRS. So in your case, you'll have to look at whether you use EBITDA as or the other performance measure, and if you use in your external reporting, and if you view it as showing an aspect of your performance, then it qualifies as MPM under requirements for IFRS 17, and then you'll have to give disclosure of MPM under the requirements for IFRS 17. So what are the disclosure requirements? The next slide shows. So IFRS 18 requires then that you, in case of an MPM, you will have to give a reconciliation of your management defined performance measure to a total, to a IFRS defined total or subtotal, that is shown in the financial statement, and you'll have to give a reconciliation. You will have to show the reconciling items and the effect of the reconciling items on the income tax and the non-controlling interest. You will have to explain why you've chosen a given MPM, and you will have to explain as to how that MPM has been calculated. And if you are changing MPM from one period to another, you'll have to give explanation as to why you have changed the MPM. This slide shows gives you a model disclosure, an example disclosure as to how the requirements of IFRS, disclosure requirements of IFRS can be made. So in this case of a company, in this case, the adjusted operating profit before restructuring expenses is a measure which is a MPM, which qualifies as MPM under requirements of IFRS 18. So entity begins from it, then entity gives a disclosure of reconciling items, which in this case is restructuring expenses, and then it reaches to the total required subtotal under IFRS 18, that is operating profit. And simultaneously it gives disclosure of tax effects and effect of changes on the NCI. IFRS 18, when we prepare the financial statements, we normally aggregate and disaggregate, information. We aggregate information in case of totals or subtotals, and primary financial statements are, clear example of aggregation. And if you look at the notes to the financial statements, they provide details about the numbers appearing in the primary financial statements. So the note to the financial statements is a clear example of disaggregation. So how to aggregate and disaggregate, IFRS 18 gives you a guidance as to how you can apply, you can aggregate and disaggregate, items of your financial items of your books of account. So it requires you to look at the nature of expenditure, function, measurement basis, size, geographical location, and the regulatory requirements to identify items which are similar and which are dissimilar. So, and based on that, you can aggregate and disaggregate items into your profit, into your financial statements. So we normally do it, and IFRS 18 gives you an experienced guidance on that. Besides that, IFRS 18 gives you, as I said, it requires you to aggregate based on shared characteristics. We normally do it. It also, for example, items which, let's say, if I talk about, COGS, so all expenses which relate to COGS, we normally aggregate and we show them into the notes of the financial statement. So there is a shared characteristic. Similarly, there are dissimilar characteristics. For example, we cannot categorize numbers, relating to one item into another. So there are characteristics which dissimilar, which identify dissimilarity. So based on that dissimilarity, we are required to bifurcate them, and we do that. And besides that, IFRS 18 requires you to use, meaningful labels. This is the key requirement. We normally, use others, but IFRS 18 discourages that. IFRS 18 requires you to label, as appropriately as possible, to give information about the item which actually that number represents. So other is discouraged. But if it is minor, if it is immaterial, then you can show it. But even then, you will have to give its nature. For example, other operating expenses, not other expenses. For example, other operating income, not other income. So you'll have to give meaningful levels to the financial information presented in your financial statement. I earlier talked about disclosures of expenses by nature. So it gives you flexibility either to give information based on nature or function or combination of both in the statement of profit and loss. However, if you give information based on their function in the statement of profit and loss, then you will have to give information about the nature in disclose information about the nature as well. And besides that, it requires you to give information on five expenses in a note to the financial statements about their bifurcation. And the next slide shows the model disclosure as to how that bifurcation can be disclosed. And the disclosure requirements, of IFRS 18 does not exempt, entity from applying other specific disclosure requirements contained in other IFRS accounting standards. So you'll have to meet that as well. So what are those five expenses? Those five expenses are depreciation, amortization, employee benefits, impairment reversals, losses, and investment write-downs. So you'll have to give information about them, about their bifurcation in a note to the financial statements, and bifurcating them as to how their total numbers have been bifurcated, have been taken to, let's say, expenses shown by the function into the statement of profit loss. For example, this example shows total cost, total amount of depreciation 100 rupees. Out of that, 5 rupees is capitalized, 95 remains. Out of that, you have categorized 90 into different categories of your operating category. 50 cost of goods sold, administrative expenses 15, research and development 25. So overall 90 you have categorized into your operating category, and the rest 5 has been categorized into investing category. So this has been disclosed in the descriptive form. So this is a kind of disclosure, a model disclosure, which you can give in your financial statements while giving information on bifurcation of these 5 expenses in as per requirements of IFRS 15. What are other changes? Basically, so as regards, IFRS 18 requires has made certain changes, consequent changes into IS 7, and and also IS 33. As regards IS 7, we now, as of now, we begin these statement of cash flows when we're preparing cash flow, using indirect method. We begin with profit before income tax, and then we take adjustments of non-cash items. But now, as per requirements of IFRS 18, following changes have been made that now statement of cash flow shall begin with operating profit or loss. First change. The second change is, as of now, we have choice to categorize interest income, interest expense, interest income, and dividend income into dividend received into, let's say, investing category or operating category, or and similarly interest paid into financing category or operating category. But now you will be required to categorize them in the same category as in which you have categorized the related income in your statement. So this is the change. These are two changes which will affect your statement of cash flows, post implementation of IFRS 18. As I said earlier, IFRS 18 introduced requirement for a specific disclosure of goodwill on the face of the balance sheet, on the face of statement of financial position. Earlier, it was not there in IS 1. As I said earlier, IFRS 18, gives you a room to disclose additional measures, additional, amount per share, besides, basic and diluted earnings per share. For example, keeping the denominator same, you can change the numerator. For example, you can use required income or expense total or subtotal required by IFRS 18. That can be your numerator divided by your total number of shares outstanding, and or a common subtotal listed IFRS 18, or an MPM disclosed by the entity. You can use these numerators and determine the additional earnings per share and disclose them. So when you implement them, obviously IFRS 18 requires, when you implement requirements for IFRS 18 requires implementation retrospectively, and you'll have to you will have to make comparative changes into your statement of profit loss. IFRS 18 requires you to restate the comparative information, and you'll have to give details of them, and for each line item of statement of loss, and you will have to give restatement. You'll have to apply IFRS 18 retrospectively, both in the annual financial statements and also your interim financial statements. While you implement IFRS 18, it will obviously require changes in your performance reporting, and for doing that, you will have to look at your systems, and you'll have to make required changes in your reporting systems. You will be required to train your staff in order to implement IFRS 18, and you will also be communicating changes in your performance reporting to your internal and external stakeholders as to how performance reporting has changed from that which was being done as per requirements for IFRS. So these implementation and transition areas you'll have to consider while implementing your IFRS 18. So how will the statement of profit loss will look like? This is a case of a normal manufacturing concern. In that case, we have operating category, a normal operating side, revenue, cost of goods sold, gross profit, selling expenses. So this gives you a total of operating profit, and then we have few items of income which are categorizable into investing category as per requirements for IFRS 18, share profit from associate, and interest income from cash and cash equivalents. As I said earlier, these need to be categorized into investing categories for a normal manufacturing concern, and interest expense on borrowings for that involve raising finance, that need to be categorized into financing category, and interest expenses on other liabilities, for example, your pension liability, for example, these liabilities that need to be categorized into financing category if you are a normal manufacturing concern. So if you're let's say, and then this slide shows you your required subtotals, operating profit, and profit before financing income tax, which is required, and profit or loss from discontinued operation, profit before income tax, and profit for the year. So required subtotals are three: operating profit or loss, profit before financing income tax, profit for the year. And the five categories are basically your operating category, your investing category, your financing category, your income tax, and your discontinued operations. So this picture, this shows you as to how, if you are a normal manufacturing concern, how will your profit or loss, statement of profit or loss will look like. This is an example of a statement of profit or loss of an entity whose principal business is basically insurance, which is into insurance business. So its operating side will include items of income expenses from insurance business, that is into insurance revenue, insurance service expenses, etc., reinsurance related expenses. And since investing into assets is also part of its operating business, it is also its main business activity. So income and expenses rising from investing side is also categorized into operating category. And after that, as I said, share profit from associates for accounted for using equity method will always be categorized into investing category. So this is the case here as well. And then we have subtotal profit before financing income tax, and after that we have interest expense on borrowings and pension liabilities, which is required to be categorized as financing category. and this is there. And then we have, income tax expense, and then we have profit for the year. So this picture, shows as to how a statement of profit loss of an insurance company would look like, post application of IFRS 15. This is about, this is about a statement of profit loss of a bank. And in case of a commercial bank, all the items mainly, that relate to investing will be categorized into operating category, and also that relate to providing financing to customers will be categorized into operating category. And if it has, share investment in associates which are counted, or joint ventures which are counted for using equity method, then in their case also, the share profit from that item will always be categorized in investing category. And if it has pension liabilities and lease liabilities, so in that case, the interest expense on pension lease liabilities will always be categorized it will be categorized as non-main financing entity. It will not be part of it will not be part of operating category, as IFRS 15 requires it to be shown separately from operating side. And then we have, if you look at the subtotals, we have operating profit, required subtotal. We have, subtotal of profit or profit from operating and investing activities. Because in case of a bank, profit, because they have labeled it, appropriately. In their case, profit before financing and income tax would not be appropriate. And then we have, total required total of profit for the year. So this is how the profit or statement of profit loss of a commercial bank would look like, post application of IFRS 18. Then we have this is your comparison of a statement of profit loss of a manufacturing concern, in Pakistan. So the left side, statement shows current presentation as per IS 1, and the right side one, shows presentation as per requirements for IFRS 18. So in current scenario, we have, other income, other gains and losses, and this company has also, investment from investment in associate which are accounted for using equity method. And this company has also certain lease liabilities and certain, some bank borrowings. And so in their case, post application of IFRS 18, it will have to show, share profit from associates and joint ventures, accounted for equity method under investing category. And it will also be required to disclose, interest expense on borrowings under financing category, interest expense on let's say lease liabilities, under financing category. So this is how the presentation will change from current presentation while you implement IFRS 18. Similarly, this is case of an insurance company. So in that case, they are showing finance cost, separately. There is no categorization of. They are showing finance cost post, operating category. But in their case, they also have share profit from associates. So share profit from associate will be reclassified. I would say recategorized from operating to investing category in their case, and let's say. And if they have, borrowings and interest expense on borrowings and other liabilities and financing side, then it will be shown separately. And this is how their statement of profit loss will look like. This is case of a bank, share profit from associates. This is shown in their operating category side. As per current presentation, but post implementation of IFRS 18, it will be categorized into investing and shown, after operating profit. Similarly, they have pension lease liabilities, so they will be categorized into financing category, and they will be giving their required subtotals, as required by required subtotals, operating profit, and operating profit from operating investing activities, and profit or loss for the year. So that's all from my side. And now I would like to invite, we have a good team we have a team of IFRS experts, our distinguished panelists. We have who are part of our IFRS advisory group. We have Mr. Shoaib Ghazi, who's chairman IFRS Advisory Group. Besides him, we have Mr. Atif Malik, who is who is an IFRS expert and part of our IFRS Advisory Group. We also have Mr. Khattab, and he's an expert on IFRS accounting standards, and he's also part of our IFRS accounting advisory group. So now the floor is open. Anyone who would like to ask any questions, can put their question into the chat box, and we'll be looking at where our distinguished panelists will be answering to them. And first, I would like to ask, we have certain sample questions which we'll be raising to our panelists, and they'll be answering to them. And after that, our panelists will be taking questions which you would have put into your chat box, and then you are requested to put also your name, to state your name and your organization name in the chat box. So this
already there are certain points people have written in the chat box. So
Okay.
ask someone to take up those points first and then take the next question.
Okay.
That would be better approach.
So Imran, I can start taking few of these questions if you
Yeah.
allow me. Right. Okay. Thank you for your questions. I think the first question is from Syed Zuhair Raza, and it's talking about the main business activity only means object clause as disclosed in note 1 to the financial statement under status and nature of business note. Now, it is not necessary that your main business is only the business which you have actually stated in your object clause. So main business is actually a statement of fact. What is your main business? If you are already providing subtotals, one of the way which you actually identify your main business is, for example, you are already providing subtotals for net interest income. So this means that your main business is actually providing financing to customers. For example, you are a bank or a financial institution. We can also look into the segment reporting note. So that will also give you an idea of what is your main business. So main business is a factual statement, and for entity to actually ascertain what is the main business, it should come natural to an entity. So again, I don't see any issue in identifying a main business. Second question is from Kareem Kurban Ali. I think the question is about the cash and cash equivalent, and it's a question for cash and cash equivalent unrelated to providing financing to customer. What is the accounting policy choice? Now, for usual entities, the cash and cash equivalent, any income earned on the cash and cash equivalent would usually go into the investing part. But if you are an entity whose main business is actually providing financing to customer, then you have a accounting policy choice that you can classify income from cash and cash equivalent either as an operating activity or investment activity. So there is an accounting policy choice between operating and investing activity. I think there are two further questions. So one is in rather opinion and one is a question. So the gap difference between the IFRS and US GAAP, you're right. This is a question from Sayyid Imtiaz Hussain, who is highlighting there is still a gap difference between IFRS and GAAP when it comes to IFRS 18. So you're right. There are a number of projects going on at the ISP level when they tend to actually kill the differences between IFRS and US GAAP. But as of now, the IFRS 18 and US GAAP 740 are not aligned. So there are differences. Again, there is a comment that IFRS 18 has made financial statement complicated. Actually, the objective of financial IFRS 18 was actually to make it more clear and structured. So when ISB says that we want to make P&L look, especially the primary financial statement, to look like a useful structured summary, so they wanted to increase the comparability of the financial statement. And if you see, There is no change in terms of recognition and measurement of any line item. There is only a change in the presentation as to how these line items are presented, especially when it comes to P&L. So I don't think there would be much complicated. There would be certain efforts required in the first year of implementation, but once it is implemented, then you're going to see the benefit that it will increase the comparability of financial statement from one entity to another entity. I think that's all for the time being.
Imran, I
Yeah.
think there are certain questions in chats as well. One of the frequently asked question is that, are you going to be providing the slides somehow on the institute website or something? So if you can answer that first.
Yeah, we can do that. I mean, we can do that. This webcast or this webinar would be posted, and and those who want to see it later on, they can look at that. This is usually our practice.
Okay.
Imran, please put the recording as well as separately the slide bundle as well. So people can download, people can check there, and also
Yeah,
they
so
can.
we'll do that as well. Yeah.
Yeah, please. Thank you.
So, Imran, would someone be starting to take questions from the chats? There are a number of questions over there.
Who's going to read those questions?
So-
Samir or who is going to read those questions?
Okay, I will
So
read the
for
questions.
cash and cash equivalents unrelated to providing financing to customers, what is accounting policy choice? So, I mean, if you are into business of investing into cash and cash equivalent, and the accounting policy choices that whether you can categorize the items, income expenses arising from cash and cash equivalents, either into investing category or into operating category. So this is the accounting policy choice. So once that choice is adopted, then you will have to consistently do that, every year.
Okay, so next question is IFRS 18 applicable on all companies in Pakistan, including SMC
Yes.
private limited companies?
No, it's applicable on all companies.
Yes, it is.
Okay, so do we have to prepare a financial statement for the year ended 2026 as per IFRS 18?
No, effective date is from January 1, 2027. So financial statements, interim or annual financial statements prepared, for periods beginning on after January 1, 2027 will be prepared using the requirements of IFRS 18.
However,
Next
Imran, the
question.
comparatives, I think, will be have to be amended accordingly. So
Accordingly.
the preparation has to start from now for all the entities so that they map their, let's say, chart of accounts in accordance with the requirements of IFRS 18 so that they are ready for when it is actually implemented. So for December, it will be December 27 as an annual period, but of course, the interim reporting changes would apply before that. For June year ends, the first year end is going to be June 28 actually. But again, the interim reporting is going to start before that.
Yeah.
So
On the March quarter, then
financial,
it will be starting.
Yeah.
so financial charges on leases under IFRS 16 will be recorded under either operating activities or financing activities.
No, these will always be categorized into financing category.
Okay. So for each category, that is operating, investing, and financing, do we have to present separately for each income and its related expenses?
Sorry?
For each category, do we have to present separately for each item of income and its related expenses in each category? The answer is obviously yes.
Yes, obviously.
Yes.
Under IFRS 18, foreign exchange gains and losses must be classified in the same categories as the underlying transaction that generated them. How should an entity allocate foreign FX gain on losses on a single bank account that is used for both operating activities and investing activities?
So if it involves, undue cost or effort, then the IFRS 18 gives you a choice that you can categorize the total FX gains and losses into operating category.
Right.
How would you see the application of IFRS 18 for mutual funds financial statements, where investment is their main business activity and they book unrealized gain losses on daily basis? So these will become part of their operating income. This is the question.
Yes, operating. Yes.
Yes, it will be operating income. Yes.
Okay. So if we have to apply IFRS 18 retrospectively and MPM was not set for comparative year, how it will be shown in the financial? Are there any exception for the MPM specifically?
No, for MPM, you'll have to give comparative information. This is a requirement.
And you even need to give it in interim financial statement as well.
Yeah.
So to start giving MPM from the interim financial statement, the first interim financial statement after the effective date. So you need to give MPM in that.
Disclosure about MPM. Yeah.
Realized and unrealized gain on investment under IFRS 19 to be placed under investing category.
Yes, if you are a normal manufacturing concern and income expenses arising from your investment will be categorized into investing category. And if you're a bank, if you are into main business, if your main business is investing into this kind of assets, then you'll have to determine your main business activity, and according to that, you'll have to categorize income expenses from that from those assets into your operating category.
जी इसमें से जो बेसिकली जो पीएनएल में जा रहे होंगे रियलाइज गेन एंड लॉस वो ऑब्वियसली इन्वेस्टिंग एक्टिविटी में जाएंगे और कोई भी गेन एंड लॉस ओसीए में जा रहा होगा वो तो पीएनएल का पार्ट ही नहीं होगा तो ओसीए में देयर इज नो कैटेगरी
OCI, so we will always remain in OCI.
So under IFRS 18, if a company has historically disclosed EBITDA as a non-IFRS measure, does it automatically become a MPM, or does this depend on how management use and communicate that metric?
Yes,
If management use it in its external reporting, then it shows that management views it as to show an aspect of its financial performance. If it is, for example, if it is using it in its annual report, an annual report is being published, and an annual report is being shared externally, then obviously it will meet the criteria of MPM, and then you'll have to disclose it. You'll have to meet disclosure requirements.
So the next question is basically it's a comment that the end result would remain same.
Yes, obviously.
Yes. So IFRS 18 can be adopted early.
So sorry, I was just saying there is no change in recognition and measurement. It's only a presentation change.
So can we early adopt the IFRS 18 before 1st January 2027?
Yes, it is permitted with a disclosure.
The investment and financing part in PNL is only disclosure difference from current presentation, or there will be some additional cost to be recorded under these categories?
This is only presentation change. I mean, this standard, does not require, changes in recognition or measurement criteria.
What should be the roadmap / steps to adopt the IFRS 18 once the finance team understand the requirements of IFRS 18? Also, what are the difficulties the industry is currently faces based on the comments received by ICAP?
Yes, I think the very first step is to first understand what the IFRS 18 stands out, and for entities, second step would be to read the financial system, the entity, how information from the entity is generated and how it's summarized. And obviously, the third step would be to align this IFRS 18 requirement with the entity's system. So, in most cases, it might be straightforward, but as Imran also duly pointed out, that there could be certain entities where significant changes to the existing financial reporting system might be required, so that information is presented in the manner that is required by IFRS 18.
Okay, I would suggest that once 2026 accounts are ready, people should do impact accounting on the basis of that. That will help them to put in line every disclosure which will be coming in 2027, as well as they will be having the comparative ready at that time. That's what the impact exercise need to be carried out, I think, at the year. That would help them in meeting the requirement.
I would comment on this that I mean, if you are, if you are required to report quarterly, results as well. So you need to, since IFRS 18 would apply from January 1, 2027, and with changes in comparative, with restatement. So you'll have to look at your current reporting as well, yeah, and you need to be proactive. You need to be identify what changes are required, and obviously there may be certain changes required into your systems, into your so you need to be proactive. You need to work as early as possible to identify the changes required, and so that when we prepare your first quarterly financial statements, then you do not face any surprises. So being proactive is the key in this case.
So will the applicability of IFRS 18 prevail on non-profit organizations also with adequate disclosures?
Yes, IFRS 18 also, as I said, it will replace IS 1. So this applies to non-profit organizations as well.
So for the first time, financial statements are prepared under IFRS 18. Will the amended comparative period will be presented for only 1 year or for more than 1 year?
Only 1 year.
Okay. So the next question is, will
interim
MPM
period as well.
Yes. So the next question, will MPM will require restatement? I think we have answered it already. Can we get any example for cash and cash equivalents to be recognized as operating activities in profit or loss, or company whose core business is not financing?
Is not financing or is not investing?
Is not financing, whose core business activity is not financing. So if it's not a financing activity, then it should be of investing activities.
No, if you're a normal manufacturing concern or a service organization, in that case, let's say if you have a bank account and or let's say if you have short-term investments and you earn profit from them and they qualify as cash and cash equivalents, then return from them, you'll be showing them under investing category in your statement of profit loss. But if you are a bank, let's say, and if your main business is investing and providing simultaneously financing to customers, so in that case, the profits from those investments will be categorized into operating category in your case.
We'd just like to add one thing regarding that third year comparative as well. Normally, if a profit and loss account or statement of profit and loss is amended, it will not result in a presentation of comparative for more than 1 year. But in case an entity has a goodwill and it was previously classified under intangible asset, and there is now a reclassification or a restatement and statement of financial position, so there might be a case that a comparative for more than one period are required to be presented. So just wanted to add.
As regards balance sheet, yes.
Okay, so for the consolidated financial statement of a parent, the same categorization will be carried in the financial statement in the consolidated financial statements as they are in the individual financial statements of the subsidiaries.
It's not
in your
necessary.
bank, not
Yeah, sorry.
necessary.
Yeah, because the main business of the subsidiary might be different from the main business of the parent company. So if a subsidiary has a different main business than a parent company, so there may be a change in the operating and investing and financing activities.
So the next question, what will be the presentation of transfer of unrealized gain and losses on investment in IFRS 9 from OCI to profit and loss? I think we have already answered that. कि जो statement of profit and loss वहां तक change होगी, other कोई change नहीं आएगी. WWF and PPF expense to be presented under operating category. Further, foreign exchange gain loss on bank balance to be presented where?
So WWF, it would probably relate to your operating activities because it's the expenses are going into that area. And the second question was regarding to the income on
Foreign
bank.
exchange gain, yes, foreign exchange gain loss on bank balance.
Right. So you need to see where the related income or expense is going. So the foreign exchange gain and loss will follow that income or expense. So if it's going into the investing category, then it will go into the investing category. If it's going into the operating category, then it will go into the operating category.
Khatab, with respect to WWF and WPPF, as you mentioned, is going to be an operating category. Can you also provide guidance on the minimum tax, the guide that ICAP had issued, and where we came with the concept of levy? So where would that be classified?
Thank you, Shoaib sir. So IFRS 18 actually has a criteria for investing and financing activities. So there is a criteria that these type of like if you are investing in you have investment in subsidiaries and associates, or you have an investment in other assets which are able to produce return independently of other business activities, or you have a cash and cash equivalent. So return on these type of assets will go into your investing activity. Similarly, if you have basically financing charges on your borrowings, then those will go into the financing activity. So there is a criteria. Other than that, there is a residual category for all the other items, so that will go into the operating activity. So as we know that levy, which ICAP has issued a guidance that these levy are not income taxes within the scope of IS 12. So these are need to be assessed whether they belong to the investing activity or the financing activity. If we say, because we know that these levies are in major cases being calculated on a turnover basis or any stream of other income, so they probably would end up in an operating category because they are not income on your associates or joint ventures. They are not levy on your income on bank accounts. So they will probably be calculated with reference to your turnover or your sales. So it will end up in as a part of your operating profit.
Thanks.
So after adoption of IFRS 18 in June 2027, reclassification of corresponding figures are separately disclosed or not?
Yes, you will have to give a breakdown. I mean, on the face of the P&L, you will have to reclassify. You will have to change your comparatives, and if required, I mean, if changes need to be explained, obviously you'll have to give a breakdown as to how changes have been made. So you'll have to explain them in a note to the financial statement, explaining how
And just to
expenses have
add
been
to it,
recalculated.
yeah, there is also a requirement that you have to present a reconciliation that this was presented previously under IS1, and now this is the classification has changed because of the adoption of IFRS 18. So that reconciliation is also need to be there in the first financial statement post adoption of IFRS 18.
So there will there be any impact on IFRS 18 on IS 33 earning per share disclosure?
Yes, I explained. I mean, there is an IFRS 18 as part of IFRS 18. Certain changes. I mean, certain requirements have requirements. I would say certain room has been created for preparers that they can give additional measures of earnings per share besides basic earnings per share and diluted earnings per share. So the requirement for disclosure of basic and diluted remains same, but you can use additional earnings per share. You can disclose additional earnings per share based on, let's say, using numerator as, for example, using a subtotal, shown on the face of the balance sheet on the profit loss, or let's say using an MPM. So it gives you a room to give additional, earnings per share, to disclose additional earnings per share. But the original requirements remain intact.
Okay, so what about banks? Considering there is a State Bank of Pakistan has issued some formats for the banks.
State Bank has not issued the format yet, but at ICAP level, ASB had taken the initiative, and the DTS, the Technical Service Department, has prepared a format, and it is under review currently. And as soon as it is completed, it will be shared with State Bank, and then of course State Bank has to communicate in whatever way with the banks. Similarly, I think on insurance, For insurance companies, ICAP has already completed the work. The ASB, I think, has forwarded that to SCCP for their review. And whatever communication is going to come from there will be seen. I think that there are some ongoing communication between ICAP and SCCP. Similarly, I think certain changes may come to financial statements of mutual funds or other NBFCs as well, which I think I think for example, MUFAP should evaluate if they want to take the initiative, because a lot of requirements in those financial statements are also coming from NBFC regulations. So again, they will have to get engaged with SCCP to bring those changes in those formats.
Okay. So there's a next question for standalone financial for NPO. We have already answered that question. So the next question: we are a group of companies in KSA. Our holding company has centralized treasury function, which provide treasury services to all subsidiaries and joint ventures, make short-term investments, and earns interest. For a treasury department, it is an operating activity. However, how we will treat this service like agreement services and interest income in holding company separate financial statement and in consolidated financial statement, whether as an operating income or investing income?
I mean, the assessment for main business needs to be done on a reporting entity basis. So you need to understand what is the subsidiary main business versus what is the holding company main business. So it may be possible when you're preparing subsidiary accounts, you need to look into the main business of the subsidiary, and the operating, financing, and investing activities would follow that main business assessment. And separately for the holding company, if you are preparing consolidated accounts, then again the main business of the group, the holding company, would be into the consideration when you are actually presenting your financial statement.
Okay. So final taxes classified as levies would need to be bifurcated into investing, operating, and financing activities.
I think I answered that question, that the levy, which is not within the scope of IS 12, would end up in as an operating profit activity.
Okay, so but if the State Bank could not notify it by 31st December 2027, then what should bank do?
Bank should follow the applicable financial reporting format that the State Bank has given for the time being. Because I think for banks, it is mandatory to follow the format for the State Bank. So until there is a revision, that's why ICAP is in proposing SPP, so that when the time comes, they have the format ready. So if somehow it's not practicable or it's not notified by the State Bank, then obviously bank has to follow the format which is currently applicable to banks.
Okay, so we are a holding company with multiple subsidiaries and joint ventures. Holding company doesn't have any operations. It makes investment in public companies, private companies. Will this be a operating income or an investment income? Do we need to disclose related expenses separately or in the same category?
I think Khatawat covered that, right? Already.
Yeah.
Exactly. So the next question is also the same. The fair valuation of investment property will be in investing category if we are real estate companies. So obviously that will be your main business activity. And as per IFRS 8, as IFRS 18 requires entity to classify income and expenses on their main business activity for diverse conglomerates operating across multiple sectors, how would you define that boundary of main business activity?
That's a good question.
You will have to use judgment. You will have to identify whether you are into business of investing or, let's say, or financing, providing financing to customers. Besides that, the principles are clear. If you are, let's say, and if you are a parent company, and if your main activity is investing, let's say, if you have then you'll have to look at, you'll have to judge and you'll have to look at the requirements for IFRS 18. And if you determine that, investing into assets is your main business activity, then obviously you will have to categorize income expenses from those investments into your operating category. But the principle is clear: free share from investment in associates will always be there in investing category. So you will have to apply requirements of IFRS 18. You will have to use judgment, and then you will have to determine what your main business activity is. And based on that, you will have to apply requirements for IFRS 18 to determine as to how the items of your income expenses need to be categorized in your statement of profit.
So the next question is, some of the MPMs are highly confidential and companies might not be comfortable sharing them, such as
So
number
the
of new
criteria for
products
MPM
launched.
is that one of the criteria, one of the points, one of the criteria is that it need to be used in external communication. If it is confidential, that it cannot qualify as MPM.
So the next question is, how the auditors will deal with the adjustments when MPMs are now audited disclosures rather than external reporting matrices.
Pratap sir?
Yeah. So, the MPMs are basically subtotals of income and expenses, which are already there in your P&L. So you're actually presenting them in a different way. For example, if there is one-off restructuring cost, and you wanted to highlight your operating profit without that restructuring cost, so that can be in MPM. So these balances or transactions are already recorded in the ledgers of the entity. So I don't think there would be an issue in auditing this, because ultimately the MPMs needs to be reconciled back to the profit and loss as given under the IFRS framework.
Okay. So income statement of insurance company showing total revenue but expenses split into insurance and reinsurance net amount will not give correct picture. So as the panelist said, the insurance format are already forwarded by the ASB, so they will be updated. In the Middle East region, currently zakat is presented with income tax expense after profit before zakat and income tax. Will this presentation of zakat expense remain same under IFRS 18 also?
I think it depends. If zakat is presented with normal tax, so it might be qualifying the income tax criteria under IAS 12. So if it qualifies to be a tax under IAS 12, which is any tax on your net income on net basis, so it will remain the same in the same category. And also, I think it also depends what kind of local regulations are there. If local regulations require zakat to be presented in a way it is, then obviously it will be something that will need to be followed. So in case it does not come under a tax and no local regulation shall be followed, then obviously it will be going to be as a reclassified as an operating category expense item.
So kindly explain the impact of regulatory deferral balances. What additional subtotals are required to be presented in case if IFRS 14 is applicable to an entity?
Well, I think if an entity is applying regulatory deferral balancing or IFRS 14 for that matter, the main impact should be change in the numbers in the operating category. So the main change, the categories would remain the same. The subtotals should remain the same. Only the numbers that are recognized should be in accordance with IFRS 14. So in substance, there should not be much difference, misalignment with IFRS 18 in that case.
There are some other questions that we have already answered related to MPM, final tax, operating main business activities, and that's it from the chat box, both from the question and answer and chat box.
Thank you. So,
And do you have any question to ask from the distinguished panelists for the purpose of some more explanation or something? You have some?
those who have raised their hands, they can put their questions into chat box, and
Yes.
we can deal with them as well. Yeah, Saad and Shahzad Aslam, you can write your questions into the chat box.
Yes, I have already written my question in the question and answer tab. So can you please answer that?
What was your question?
So it's regarding the holding companies' income and expenses. If the holding company is investing in subsidiaries and associates, and it also investing its funds in mutual funds and in other like government bonds, etc. So either these will be classified under operating activities, or the interest on subsidiary loans and dividends from the subs and associates will be classified as operating incomes or the investing incomes.
It's already answered.
Yeah,
Question
but I couldn't get that, so that's why I'm asking again.
So, Shehzad, the assessment regarding the main business needs to be taken on an entity by entity basis. So for the holding company, if the main business is investing, then they can take a view that my main business is investing. So the return coming from this investment are my operating activity.
So I think whatever the holding company's business is, you mentioned that there are the one of the objective of that company is to invest in subsidiaries, and the other is that they are also investing in, let's say, other investments like mutual funds and T-bills, etc. So if the sole purpose of the company is actually to be a holding company to its subsidiaries, then whatever they are doing with them could be the operating. But if they have excess cash and they're investing, let's say, in mutual funds, then they may be classified as an investing activity. I mean, it has to be seen from an entity perspective what the main business is.
Okay, thank you.
Are there any other questions, Imran?
Naveed, you may raise your question.
Assalamu alaikum, sir.
Mr. Nal. Assalam.
Sir, I have a question. After the application of IFRS 18, levy will remain applicable?
Yes, because I mean, those are governed by IFRIC 21 and and IF 12. The guidance remains same. I mean, would not change. IFRS 18 is about presentation changes only.
So, sir, if a company pay final tax on an income relating to investing income, so as of now, final tax will be presented in under the head of levy. But after the application of IFRS 18, what will be the presentation of this final tax on the income relating to investing activities?
So you will have to look at, I mean, whether, you will have to look at the requirements, and the only change, I mean, there will not be any change as regards measurement of levy. And
Okay, sir.
now generally,
So
levy will be categorized.
I think the question is this, that, and maybe Khadab, if you can also help. If somebody has invested, let's say, in shares, and it earns dividend, and its dividend on shares is like investing activity, but it is final tax at 15%. So would that be considered as, would that levy, which is the 15% tax, be classified under investing or operating? I think it would be investing, because it is linked because that's where we have classified the original income from. Unless someone else has
Fine.
another view, Khatab and Atif, if you would want to add something.
I would agree to that because the income is going under the investing category and there is a final charge. So the expense would also be going in that category.
So the dividend, basically the investing categories has defined incomes. So the income that is generated by asset is investing categories, and any directly attributable expense to that asset will only be your investing expense if that is incurred on acquisition or disposal. Okay. So if a dividend is earned during the lifetime of the asset, then the income would be your investing activity, लेकिन उसका कोई related expense होगा वो investing में नहीं आएगा. Directly attributable expenses जो है वो सिर्फ और सिर्फ acquisition और disposal पे होंगे. तो अगर आप disposal पे कोई tax pay करते हैं वो that will be directly attributable to that asset, तो तब वो investing में चला जाएगा.
So then we will be classifying that levy on investing incomes in the operating category.
Yes, income
Yes,
on
from
income
the
earned during the
requirements.
period. Yes, yes.
So IASB in their basis of conclusion did say that they considered that approach कि हम सारे attributable expenses जो हैं वो सारे के सारे P&L में investing activities में ले जाएं, लेकिन but they confined that to only addition, acquisition and disposal. Otherwise, only the return generated by the asset is your investing activity. And let's say you have a treasury function that is solely giving services for this investment, so उसके related expense भी that is not the return generated by the asset, तो वो भी operating में जाएगा. For the ease of classification, they did that.
Okay.
सुनील, ये फॉरेन एक्सचेंज गेन एंड लॉस आ सकता है ना इन्वेस्टिंग में? वो एक्विजिशन और डिस्पोजल रिलेटेड तो नहीं है. हमने कहा है कि जहाँ इनकम जनरेट होगी उससे रिलेटेड जो फॉरेन एक्सचेंज जो है उसी कैटेगरी में जा सकता है. तो इसलिए डोंट रिस्ट्रिक्ट टू दैट लाइन कि वो जो एक्विजिशन और डिस्पोजल को टू मच एम्फोसाइज करने की जरूरत नहीं है. जैसे अभी खताब साहब ने भी कहा था कि इफ द इनकम इज रिलेटेड टू इन्वेस्टिंग, उससे रिलेटेड अगर लेवी का पोर्शन पे हुआ है, that would be, and we at institute should look at that in detail. But apparently जो panel की understanding है कि if need to be bifurcated because logically relate to that, it has to be there, right? जैसे मैं example दूंगा, कैश फ्लो स्टेटमेंट तब एनालॉगी क्रिएट करने के लिए वहां अगर इन्वेस्टिंग फाइनेंस रिलेटेड कोई टैक्स पोर्शन होता है तो उधर दिखाते हैं, अदरवाइज आप ऑपरेटिंग में दिखाते हैं. समथिंग वी नीड टू maybe deliberate more, but apparently the panel answer this stage is it may have to be bifurcated. Kunji Khattab sir?
So we can, of course, look at it into detail as well, but it makes sense that you have an income going into that category, and if there is a direct charge on that. Yeah.
Any other question, please?
Yeah. I think we have answered all the questions, and it has been a wonderful session. And we are thankful to all the participants. Now, I would like to ask Mr. Jahazeb Amin, our esteemed Vice President, to give his closing remarks. Over to Jahazeb sir.
Thank you very much, Imran. Bismillah ar-Rahman ar-Rahim. Nahmadu wa nusalli ala rasulihil kareem rabbi rahmuma kama rabbayani saghira. Thank you very much, Maqbool Sahab, AS Board, for leading the show and the efforts that are put in by Imran and Sameer. Much appreciated. I'm very grateful to Shoaib Ghazi Sahab, Khatab Beg, Atif Zamarud Malik for taking out the time for this very informative session. We as professional accountants carry the responsibility of creating trust and value in the society. And our tool, of course, is the presentation of financial statement. The more betterment and refinement that we can strive in bringing that, perhaps that need has been assessed and has been very rightly set at the tone
for the future reportings. It's a happening world. Things are continuously evolving and changing. So is the appetite of stakeholders and the need, the way they want to see the financial statements. So I think it's one big step that is going to reshape the financial statements of future. And in our relevance for the future, we need to be appropriately prepared. I know, I mean, most of you will be aware that transition to IFRS 9, 15, 16, that had been demanding on very many fronts. But change is a continuous thing that is happening, and we have to be responsive as professional accountants to live up to the expectation. So I'm very grateful to all the panelists for our ICAP team, and of course the participants who have very interactively, brought so many things that were of mutual benefit and of information to all. So look forward to contribute more to our fraternity and the way ICAP can lead the show. Thank you all. It's been pleasure working with you, and look forward to bringing more informative sessions to you. Thank you so much. Over to you, Imran.
So with this, we conclude our session, and we are thankful to all our panelists, all participants, our esteemed, vice president and our chairman accounting stand board. So thank you all, and inshallah, look forward, inshallah. So let's close the session. So Allah Hafiz.
Allah Hafiz. Thank you.
Allah Hafiz. Thank you.